Thinking of getting life insurance but stuck between term life and whole life? You're not alone. I've been there too. Scrolling through endless comparison tables and sitting through those friendly copy chats with agents that somehow end up with a sales pitch. And here's the thing, a 30-year-old woman could pay about $350 a year for term insurance or up to $3,000 a year for whole life. Same coverage amount. One wrong choice and you could either be overpaying for decades or worse, end up underinsured when your family actually needs it. So in this video, let's cut through the noise. We'll break down what term life and whole life really are, the pros and cons of each, how to know which one makes sense for your life stage, and a few practical tips that could save you thousands. Hi, I'm Fer from Dollar Bureau, a personal finance platform that talks about insurance, investments, and financial planning. Alright, let's start with the basics. What exactly is term life insurance? Term life insurance is the most straightforward form of life insurance. You pick a period, maybe 20 years or 30 years, or even up to an age like 65 or 75. During that time, if you pass away or you're diagnosed with terminal illness or become totally and permanently disabled, your loved ones will receive a payout. That's it. No savings, no investment components, just pure protection. And because it's so lean, it's so much cheaper than whole life insurance. Think of it like renting insurance. You only pay for it during the years you need the most coverage, and once that term ends, it's gone. So, if it's that simple, why do so many people go for term insurance? Simple. It is affordable and flexible. You can get $500,000 worth of death coverage for just a few $100s a year. That means more of your budget can go into things like investments, savings, or even just daily living. And here's a bonus. Many term plans let you add riders for critical illness or early critical illness. So if something like cancer or a stroke happens, you get a payout that can help with treatment costs or give you breathing room to take time off work. Some even come with a conversion option. You can switch to a whole life plan later on without another medical checkup. Of course, nothing's perfect, and term life insurance has a few catches you need to know. But first, let's talk about the advantages of term life insurance. Number one, it is the cheapest way to get the highest form of coverage. The biggest advantage of term life insurance is affordability. For just a few $100s a year, you can get yourself insured for up to hundreds of thousands of dollars and sometimes even millions of dollars. That means your family is financially protected if something happens to you without you having to sacrifice your daily lifestyle or cut back on savings. Number two, flexible term that fits your stage of life. With term plans, you get to decide how long you want the coverage for. Need protection until your kids finish school? You can pick a 20-year plan. Want to cover your mortgage? Align the term with your loan period. Some plans even go up to age 99 so you can stretch protection for as long as you feel it's necessary. It's coverage that adapts to your life stage instead of locking you in for life. Number 3. Some plans are convertible in nature. Here's a little known feature. Some term plans come with a conversion option. That means if you can only afford a term plan now, and if you decide later in life that you would prefer the certainty of whole life insurance, you can switch with no new medical checkups required. Even if your health changes, you'll still be able to get lifelong protection, which makes term insurance a flexible starting point. Number 4. Riders for CI and ECI are available. Life insurance doesn't just have to cover death. With add-on riders, you can get protection for critical illnesses or even early-stage critical illnesses. That means if you're diagnosed with something serious like cancer, heart disease, or stroke, you'll get a lump sum payout. And that money can go towards treatments, recovery, or simply giving you the space to take a break from work without stressing over bills. Sounds great, right? But let's not get ahead of ourselves, because term life, as affordable and flexible as it is, does come with a few downsides that you'll want to keep in mind. So, here are some disadvantages of term life insurance. Number 1, no savings component. Unlike whole life insurance, term plans are pure protection. That means you don't build up any cash value along the way. If nothing happens to you during the policy term, you walk away with nothing at the end. Some people find this hard to swallow. They prefer to see something back for the money they've put in. With term plans, you need to be okay with the fact that you're paying purely for a peace of mind. Number 2, renewal costs go up as you age. If your policy ends and you still want coverage, you can usually renew it, but here's the catch: the premiums won't be the same. As you get older, your risk of falling ill or passing away naturally increases, and insurers price that in. So, a plan that was $300 a year in your 30s could be several times more expensive in your 50s or 60s, even if the policy guarantees renewability without a new medical checkup. The rising costs can catch people off guard. So be sure to plan ahead and choose a coverage period that meets your needs. Number three, coverage ends when the term is up. So if you outlive it, there is no payout. This is the biggest limitation. The term life insurance is designed for temporary needs. If your plan ends at, say, 65 and you live a long, healthy life, maybe into your 70s, 80s, or even 90s, there's no payout to your family eventually when you pass on. Some insurers now offer term to 99 plans to bridge that gap, but those are pricier and blur the lines between term and whole life. The bottom line: term insurance works brilliantly if you match it to your responsibilities, but it's not meant for lifelong coverage. So while term insurance gives you affordability and flexibility, it also comes with these trade-offs. Which brings us to the bigger question: what does this really mean for you? Is a term plan for you? Well, term insurance is great if you're in your 20s, 30s, or 40s managing big financial responsibilities like housing loans or young kids. It gives you the protection you need without draining your budget, so you can invest the difference elsewhere. That's term life in a nutshell. But what about whole life insurance? Whole life insurance covers you for, well, your whole life, usually up to the age 99 or 100 years old. So, no matter when you pass away, your family gets a payout. But the big difference is that part of your premium goes into building a cash value. This grows steadily over time and you can borrow against it, withdraw it, or just leave it to supplement your retirement in the future. Think of it like owning instead of renting. You're paying more upfront, but you're also building an asset along the way. Now, you might be wondering, why do some people prefer whole life insurance despite the higher cost, sometimes even 3 to 5 times more? Number one, lifetime coverage with no expiry. Unlike term life, which only protects you for a set number of years, whole life insurance covers you all the way, usually until age 99 or 100. That means no matter when you pass on, your payout is guaranteed. You don't have to worry about coverage expiring just when you might need it most, and you don't have to deal with the stress of renewing a policy later on in life. Number two, it builds cash value over time. A big reason people choose whole life insurance is the savings component. Part of your premiums goes into building cash value within the policy. This amount grows steadily, often at rates of 2%, and you can borrow against it or withdraw from it later in life if you need to. Think of it as a forced savings plan that grows quietly in the background while you stay covered. It can be a handy safety net for retirement top ups, emergencies, or even funding your child's education. Number three, premiums are predictable. With whole life insurance, what you pay is fixed from the start. No surprises, no sudden increases as you get older. Some policies even offer limited pay options. You pay premiums for 15 or 20 or even 25 years and then you're done, but the coverage continues for your entire life. This makes budgeting easier and gives you the certainty of knowing your insurance costs won't be climbing. Number four, great tool for estate planning. Whole life insurance is often used as part of legacy planning. Because the payout is guaranteed, it helps your loved ones cover expenses like outstanding loans, funeral costs, or even estate taxes. Beyond that, it can also serve as a financial gift, leaving your children or dependents with additional stability even after you're gone. And since life insurance payouts are typically tax-free in Singapore, it's an efficient way to pass on wealth. Number five, riders for CI and ECI last as long as the policy does. Just like term life, you can add riders for CI or ECI. But here's the difference. Since whole life policies don't expire, your rider coverage also lasts for life. That means even if you're diagnosed with an illness in your 70s or 80s or 90s, your plan is still there to provide a payout. This can give you long-term protection for both medical costs and income replacement without worrying about renewals or policy expiry. Of course, all these benefits don't come cheap. So, before you get too excited about whole life, let's look at the trade-offs you need to be aware of. Number one, it is expensive, easily 3 to even 8 times more than term. The biggest drawback is cost. A 30-year-old might just pay $350 a year for a term plan with $500,000 of coverage, but the same coverage on a whole life plan could cost upwards of $3,000 or more. That's money that could otherwise go into your investments, mortgage, or even day to day expenses. For young families balancing childcare, housing loans, and savings, committing to these higher premiums can feel like a financial strain. Number two, cash value grows slowly in the early years. Yes, whole life policies do build cash value, but here's the catch: the growth is painfully slow at the start. Much of your early premiums go towards fees and commissions, which means you might see almost nothing if you cancel within the first few years. For example, if you pay $3,000 a year for the first 5 years and decide to surrender the policy in year 6, you could walk away with less than what you put in. This makes whole life a long-term game. It only works if you stick with it for decades. Number 3, returns are lower than what you might get from investing elsewhere. Whole life insurance is not designed to beat the stock market. On average, you're doing about 2% per year depending on the insurer and how their participating fund performs. Compare that to investing elsewhere, you'll see the trade-off. So, if your main goal is growing wealth, whole life plans are not the most efficient tool. You'd be better off buying term insurance for protection and investing the difference yourself. Number 4, canceling early can cost you. Whole life is not flexible when it comes to quitting halfway. If you surrender the policy early, you may lose a significant chunk of your money you've already paid in. Let's say you've been paying premiums for 8 years but decide you can't keep up. The surrender value might be far lower than your total premiums and you'll walk away with a loss. On top of that, if you still need insurance later, you'll have to apply for a new policy at an older age, which means higher premiums and potentially stricter medical requirements. Okay, so now we've covered both sides. Should I choose term or whole life insurance? This is the big question, right? And the answer isn't the same for everyone. The best way to figure it out is to look at a few key factors that affect your situation. Number 1, how long do you need coverage? Start by asking yourself, what are you trying to protect and for how long? If it's just until your debts are cleared, say your HDB mortgage or your private property mortgage, or until your kids finish school and can support themselves, then term life is usually the smarter choice. It's affordable and it covers you exactly during the years your financial responsibilities are highest. On the other hand, if you want guaranteed protection that lasts your entire lifetime, maybe because you want to leave behind a legacy or you have dependents who will always need financial support, then whole life gives you that peace of mind. No expiry dates and no gaps in coverage. But coverage length isn't the only thing to think about. The type of illness coverage you want matters too. So number 2, what type of CI or ECI coverage do you want? For term plans, once your policy ends, so does your CI protection. Whole life, on the other hand, tends to offer CI or ECI coverage that lasts as long as the policy itself. That means even if you're diagnosed with cancer or a major illness in your 70s or 80s, you are still covered. If critical illness protection is high on your priority list and you don't want to juggle separate policies, whole life might be the better fit. Of course, the next factor is one of the biggest deal breakers for most people, which is your budget. So that brings us to number 3. What is your budget? Let's be real, premiums have to fit into your lifestyle. If your cash flow is tight, term insurance gives you the coverage without you needing to overcommit. For example, a young family trying to balance childcare costs, a mortgage, and everyday expenses will usually find term more manageable. If you've got more disposable income though, whole life can give you the comfort of lifelong protection, cash value growth, and estate planning benefits. It's less about affordability at that point and more about convenience and certainty. And speaking of money, this ties directly into another important question. What kind of returns are you okay with? So, number 4, are you okay with lower but safe returns? Whole life policies grow slowly but steadily because insurers invest your money conservatively. You're looking at around 2% a year on average. It's safe, predictable, and guaranteed to some extent, but it's not exactly exciting growth. If you're comfortable taking on more risk for higher potential returns, especially if you have a time horizon of more than 10 years, then term plus invest the rest might be a better strategy. That way, you get protection from term life and put the money you save on premiums into investments that can grow faster. And that brings us nicely to one of the most talked about strategies in insurance planning: buy term, invest the rest. So here's how it works. A whole life policy might cost you around $3,000 a year. A term policy with the same coverage might only cost $300. That's a difference of 2.7k. If you consistently invest that 2.7k every year over 10 or 30 years, you could end up with a much larger pot than the cash value from a whole life plan. The keyword here is consistently. You need to have the discipline to actually invest the savings and not spend it. Otherwise, the strategy falls apart. I'll cover more on this in another video, so be sure to subscribe and hit that bell notification icon. And finally, let's not forget one last crucial factor: your dependents and whether they'll still need your financial support later in life. If your spouse, kids, or parents will eventually be financially self sufficient, then term insurance is enough. It covers you during the years when they rely on you most, and once they can stand on their own, your need for big insurance payouts naturally decreases. But if you have dependents who will need lifelong support, for example, a child with special needs or a spouse who doesn't work, whole life provides guaranteed protection no matter when you pass on. In these situations, the higher cost of whole life could be worth it for that peace of mind. So, now you've got the main decision making factors: coverage, length, CI/ECI needs, budget, returns, investing discipline, and dependence. So, should you get a term or whole life plan? If you want affordable, flexible protection for a fixed period, term is usually the smarter choice. And if you want lifelong certainty, estate planning benefits, and you're okay with paying more, whole life could be worth it. And remember, you don't have to pick one forever. You can start with term while you're still younger and expenses are high, then convert or add a whole life policy later on when your income grows. At the end of the day, it's not about which is better. It's about which one fits your stage of life, your budget, and your goals. If you're unsure, don't guess. Speak to a licensed financial advisor who can help you figure out what's right for you. I'll leave a link in the description if you'd like to connect with one of our trusted financial advisor partners. It's free and no obligations. If you found this video helpful, don't forget to like, share, and subscribe for more practical financial tips. Thanks for watching. I'll see you in the next video.